Friends, thank you for being here today. What if I told you that the silence we are currently experiencing in the financial markets is not peace, but the deep intake of breath before a historic economic scream? And what if the very institutions that have spent the last 12 months suppressing the true value of real assets have, in the dark of night, quietly switched sides to profit from the inevitable explosion they know is coming? We stand at a peculiar moment in time. If you were to look at a trading terminal right now, you would see a frozen image. The ticker tape has stopped. The screens are black. The price of silver is locked in amber at exactly 71 Taurus 47. To the casual observer, it feels peaceful. It feels like the world is simply taking a well-deserved break for the new year. But do not let the silence fool you. Under the surface, the pressure is building to a level we have never seen before in the history of the American commodities market. We are currently in the eye of the storm. Tonight, at exactly 6 p.m. Eastern Time, the electronic futures market will reopen. And when that switch flips, a massive accumulation of capital, money that has been waiting on the sidelines for the last 2 weeks, is going to flood into the room all at once. We are not just starting a new trading day. We are starting a new trading year. In the world of institutional finance, the first week of the year is known as the January effect. It is historically the most violent, explosive, and profitable week on the calendar. It is a mechanical phenomenon, not an emotional one. This is the moment when hundreds of billions of dollars of pension fund money, insurance capital, and hedge fund assets are forced, by mandate, to enter the market to rebalance their portfolios. And this year, these institutions have a profound problem. Their risk models are telling them to buy the best performing asset of 2025. That asset is silver. But there is a disconnect that the algorithms cannot account for. There is no silver for them to buy. The vaults are empty. The dealers are sold out. The miners are hoarding. So, when a $50 billion wave of institutional capital hits the market tonight, it is not going to flow gently into a liquid market. It is going to hit a brick wall of scarcity. In this analysis, we are going to dissect the mechanics of this pension fund panic, examine why the banks are about to flip their strategy, and lay out the battle plan for the next 48 hours. The countdown has started, the money is queued up, and this is the story of the January squeeze. To fully grasp why the next few days are so critical for American wealth preservation, you must first understand the internal plumbing of Wall Street. There is a fundamental difference between how you trade and how an institution trades. Retail investors trade based on feelings. They buy when they are excited and sell when they are scared. Institutional investors, however, trade based on dates. December 31st represents the fiscal year end, and up until midnight last night, the game played by the major banks was entirely about defense. Managers were selling their winners to lock in bonuses. Banks were selling assets to lower their risk scores, and taxpayers were selling losers to harvest deductions. The entire pressure of December is selling pressure. This explains the behavior we saw leading up to the holiday. The banks, specifically, were driven by the GSIB surcharge, the Global Systemically Important Bank Score. To clean up their balance sheets for the year-end regulatory snapshot, they were forced to sell assets. They smashed the price of silver down to $70.50. They achieved their goal, lowered their risk score, and saved their bonuses. But the moment the calendar turned to January 1st, the game changed to offense. The tax year is over. The regulatory snapshot has been taken. The regulators have left the room. The selling pressure is gone, and now the new allocations kick in. Every major fund has a target allocation for the new year. They may say, we want to own 2% commodities. We want to own 5% gold. Right now, having sold off in December, they own 0. They have to go from 0% to 5%, and they have to do it immediately. They usually execute these orders in the first 5 trading days of January. This creates a massive artificial wave of buying demand that has nothing to do with news and everything to do with asset allocation. It is a wall of money that hits the market like a tsunami. And this year, the tsunami is bigger than ever. Why? Because in 2025, the traditional 60-40 portfolio failed. Bonds collapsed. Stocks were volatile. Silver was the only asset that truly worked. Consequently, the model portfolios, the computer programs that tell bankers what to buy, are screaming one word: silver. They are mandated to buy. They have no choice. This brings us to the flip. Do you believe the banks are going to stay short in front of this wave? No. Banks exist to make money. They know the flow is coming. They know the pension funds are buying on Friday. So the banks are going to front-run their own clients. JP Morgan knows that the California Teachers Pension Fund is mandated to buy silver tomorrow. So JP Morgan buys silver tonight. They buy it at $72, and tomorrow they sell it to the teachers at $75. They scalp the market. This means the banks, the biggest sellers of 2025, will likely be the biggest buyers of the first 48 hours of 2026. They are flipping the switch. The suppressor becomes the squeezer because they want to ride the wave up before they short it again later. This aligns all the major forces in the market. The East is buying, the pension funds are buying, the banks are buying. Who is selling? Nobody. The miners are holding, the dealers are out of stock, and the retail investors are holding on for dear life. This is the precise recipe for a vertical price move. Let us put a concrete number on this phenomenon, because when you look at the raw data, the mathematics are undeniable. The global pension and endowment market manages roughly $50 trillion. Historically, these conservative funds ignored commodities, but with inflation sticking stubbornly above 5%, they are panicking. They are moving money out of the failing stock and bond split and into alternatives. If the global pension system decides to move just 0.1% of their assets into silver, a tiny, almost negligible fraction that represents $50 billion of new buying power. Now, look at the size of the silver market. The entire annual mine production of the planet is about 800 million ounces. At a price of $71 per ounce, that annual supply is worth roughly $56 billion. Do you see the math problem? The pension funds want to buy almost the entire annual supply of the planet in the first week of January. It simply does not fit. You cannot pour a gallon of water into a shot glass without it overflowing. You cannot buy 50 billion of silver at $71 an ounce because there is not enough metal to satisfy that demand. So what happens? The laws of economics dictate that price must act as the rationing mechanism. The price has to rise until that $50 billion buys a smaller amount of metal. If silver goes to $140, the $50 billion only buys half the annual supply. If silver goes to $280, it buys a quarter. The price has to rise to accommodate the capital. This is not speculation. This is fluid dynamics applied to finance. Tonight, the water starts pouring. The first sign of this wave will occur tonight at 6 p.m. New York time when the Globex electronic markets open. This is where the algorithms trade while the human floor traders are sleeping. Usually, holiday sessions are quiet, but tonight is different because the Asian arbitrage is still open. While New York was closed for the holiday, Shanghai was still hungry. The gap between the US price and the China price is still there. Tonight, the arbitrage bots will turn on. They will see the gap, they will see the cheap silver in New York, and they will hit the buy button. This could create a gap up right at the open. We could see silver jump from $71.47 to $73 in the first minute of trading. If this happens, it sets the tone for Friday. It tells the human traders that the dip is over. The buying has started. It creates a sense of urgency. Anyone who was waiting for lower prices will realize they missed the bottom. They will panic buy. This fear of missing out will add fuel to the fire started by the algorithms. While we have discussed the paper money lining up at the gates, we must now turn our attention to the metal itself, because while the markets were closed today, the physical shortage did not take a holiday. The factories in China are still running. The mines in Mexico are still depleting. We must address the massive disconnect between the screen and the street. If you look at the chart right now, you see $71.47. That number is flashing on screens in Tokyo, London, and New York. It is the number that the algorithms use to value billions of dollars of derivatives. But I must tell you something that the bankers will not admit. That price is a lie. It is a phantom price. It is the price of a digital contract that was traded on a holiday week with extremely thin volume. If you try to take 71.47 into the real world and exchange it for an ounce of physical silver, you will be laughed out of the room. The paper market is currently living in a fantasy land, while the physical market is living in a supply crisis. Let's look at what happened on Main Street this week. While the hedge funds were selling paper to lower their taxes, the retail public was storming the coin shops. We have received reports from major online bullion dealers in the United States and Europe. They are reporting a complete blowout of inventory. Usually, the week between Christmas and New Year is quiet, but this year, sales volume was up 300% compared to last year. Why? Because the public smells the fear. They saw the volatility. They saw the headlines about national debt. They saw the crash and the recovery. And they decided to take possession. But here's the problem. The dealers cannot restock. The sovereign mints, the US Mint, the Royal Canadian Mint, are closed for the holidays. The wholesalers are running on skeleton crews. So, every ounce that was bought this week is an ounce that cannot be replaced until mid-January. The shelves are bare. Did the dealers lower the price to match the spot market drop? No, they raised the price. If you look at the premium on a Silver Eagle right now, it is approaching $20 over spot. The ask price is over $90. This is the market telling you the truth. The spot price says silver is abundant. The premium says silver is extinct. This divergence is the most reliable signal in commodities. When the paper price drops, but the physical price rises, it means the paper market is broken. It means the shorts are suppressing a beach ball that is fighting to surface. Now, let's look at the whales of the physical world, the industrial users. There is also a January effect for industry, known as procurement season. In January, companies like Samsung, Tesla, and First Solar negotiate their annual supply contracts. They sit down with the refiners and the miners to lock in their price and volume for the year. Usually, this is a boring meeting. We need 10 tons. Here's the price. But this year, the meeting is a panic room. The refiners are telling the industrial giants, we do not have enough metal. The mines are depleting. The Chinese are hoarding. The recycling is failing. We can only give you 70% of what you need. Imagine you are the CEO of a solar company. You have a mandate to double production in 2026, and your supplier tells you they are cutting your silver allocation by 30%. What do? You panic. You go into the spot market and you buy everything that isn't nailed down. You pay any price? $75? Fine. 80? Fine. You just need the metal to keep the factory open. This is happening right now. While the markets are closed, procurement teams are engaging in off-market transactions. They are buying silver directly from the vaults in London and Zurich, bypassing the COMEX entirely. This removes the visible inventory from the exchange. When the COMEX opens tomorrow, the traders will look at the warehouse report and say, where did the silver go? It went to a solar farm in Arizona, and it is never coming back. We cannot talk about physical silver without talking about China. While New York sleeps, Shanghai eats. The price in China is still trading at a massive premium to the West, a gap of nearly $5. While New York was sleeping, China implemented new silver export controls today, January 1st. They are locking their doors while Wall Street is still trying to find the keys. This arbitrage is the engine of the shortage. Every day that New York trades lower than Shanghai, a fleet of airplanes takes off from JFK and Heathrow carrying silver bars to the east. This is not a conspiracy, it is simple math. If you can buy an iPhone for $500 in New York and sell it for $600 in Shanghai, you buy every iPhone in New York. That is what is happening to silver bars. The West is being drained of its strategic reserve. We are selling our heritage for paper dollars, and China is happily taking it. The price cannot drop below the level where arbitrage becomes profitable. Right now, that floor is $71. If silver drops below $71, the Chinese buyers back up the truck. They act as the buyer of last resort. This limits the downside risk for you. You are investing alongside a superpower that wants to corner the market. And for those who say the miners will just dig more, no, they won't. It takes 10 years to open a new mine. Even at $100 an ounce, you cannot speed up the geology. You cannot speed up the permits. In fact, supply might actually drop in 2026 due to political risk. Governments in Mexico and Peru are looking at $70 silver and getting greedy. They are talking about higher taxes and nationalization. When governments attack miners, miners stop investing. They stop digging. They go on strike. Precisely when the world needs more silver, the political environment is ensuring we get less. We have spent considerable time looking at the microscopic details of the silver market, the ounces in the vault and the planes flying to Shanghai. But if you focus only on the metal, you miss the monster lurking in the broader economy. Silver does not exist in a vacuum. It exists in a world drowning in $36 trillion of United States debt. It exists in a world where the bond market is rebelling against the central banks. We are about to enter the monetary phase of the bull market, where silver stops trading like a commodity and starts trading like a currency. The physical squeeze lights the fuse, but the monetary crisis provides the explosion. Let's look at the debt. While you are celebrating the new year, the politicians in Washington are preparing for a war. In February of 2026, the United States hits the debt ceiling again. We have seen this movie before, but this time represents a fundamentally different sequel. The interest on the debt has exploded. The U.S. government is now paying over $1 trillion a year just in interest payments. That is more than the defense budget. That is more than Medicare. It is mathematically unsustainable. So, when the debt ceiling fight starts next month, the market is going to panic. Credit rating agencies like Fitch and Moody's will threaten to downgrade the U.S. credit rating again. Foreign nations will stop buying treasuries because they are scared of a technical default. This creates a crisis of confidence. When investors lose confidence in the risk-free asset, U.S. bonds, where do they go? They go to the assets that have no counterparty risk, gold and silver. During the last debt ceiling crisis, gold rallied. This time, with silver already in a shortage, the rally will be amplified. Silver acts as a credit default swap on the U.S. government. As the probability of government chaos rises, the price of silver rises. You are holding insurance against political incompetence. Furthermore, we must discuss the bond market. Right now, the bond market is screaming. Yields are rising. The bond vigilantes are selling treasuries because they know inflation is not 2%. They know it is 5% or higher. Why does this matter for silver? Because higher yields break the banking system. We saw it in 2023 with Silicon Valley Bank. Banks hold bonds as collateral. When bonds crash, the banks become insolvent. If yields spike in January, we will see another banking crisis. And what does the Federal Reserve do when banks fail? They pivot. They stop fighting inflation. They stop raising rates. They turn on the money printer. They create emergency liquidity facilities. They flood the system with fresh dollars to save the banks. This is the Fed put. Every time the system breaks, they print money. And every time they print money, the value of the dollar falls and the price of silver rises. We are waiting for the system to break. The bond market is doing the work for us. It is forcing the Fed into a corner where their only option is to inflate away the debt. Inflation is the fuel for the silver supercycle. Wall Street analysts love to talk about real interest rates. They say if interest rates are high, gold and silver should fall because they pay no yield. This is the textbook theory. But look at the reality. Interest rates are 5%, yet silver is at $75. The textbook is broken. Why? Because the market knows the interest rate is fake. The real rate is interest minus actual inflation. If the bank pays you 5%, but the cost of living goes up 10%, your real rate is negative 5%. You are losing purchasing power by holding cash. Smart money knows this. They know the CPI numbers are cooked. They know that true inflation is double digits. So gold and silver are rising with interest rates. This is a historic anomaly that usually only happens during a currency collapse. We just finished the first wave of inflation. The second wave is building. Oil is rising. Shipping costs are rising. Labor costs are rising. Insurance costs are skyrocketing. When the inflation numbers start creeping back up in 2026, the market will realize the Fed is powerless. They cannot raise rates anymore because it would bankrupt the US government. So they have to let inflation run hot. This is financial repression. In a world of structural persistent inflation, you need assets that cannot be debased. Silver is the ultimate inflation hedge because it is also an industrial necessity. We must pause here to reflect on what this shift truly represents for the American household. Beyond the charts and the arbitrage, there is a deeper narrative unfolding, one that touches on the very essence of American prosperity and our national identity. For decades, we have been told that prosperity comes from consumption, from borrowing, from the illusion of wealth generated by a printing press. But the events of 2026 are poised to shatter that illusion, and in doing so, offer a return to the principles of fiscal responsibility that once made this nation the envy of the world. When we look at the trajectory of our federal deficit, we see a government that has abdicated its duty to protect the value of the currency. The reckless expansion of the monetary supply is not a victimless crime. It is a direct tax on the savings of the elderly and the wages of the working class. It erodes the foundation of economic resilience that our grandparents built. They understood that true security comes not from government promises, but from the ownership of tangible, unassailable assets. By positioning yourself in silver now, you are not acting as a speculator. You are acting as a steward of your family's future, stepping in to provide the fiscal discipline that Washington refuses to exercise. Consider the average American family sitting around the kitchen table. They feel the pinch of inflation not as a statistic, but as a daily reality. The cost of groceries, energy, and housing continues to climb, outpacing wages. This is the direct result of a monetary policy that favors Wall Street over Main Street. The shift we are discussing, the remonetization of silver, is the market's way of correcting this imbalance. It is a return to honest money. When you exchange depreciating fiat currency for physical silver, you are effectively voting against the debasement of your labor. You are declaring that your hard work deserves to be stored in a vessel that cannot be printed into oblivion. This strategic analysis extends beyond mere survival. It is about reclaiming American prosperity. Historically, a strong nation is built on strong money. When the currency is sound, businesses invest for the long term, families save for the future, and the economy grows on the bedrock of production rather than the quicksand of debt. By participating in this transfer of wealth, you are aligning your personal economy with the forces of reality. You are insulating your household from the systemic fragility introduced by decades of financial engineering. In a very real sense, holding silver is an act of patriotism. It is a rejection of the fragility of the debt-based system and an embrace of the resilience found in nature as resources. Furthermore, we must understand the geopolitical dimension of this outlook. As we see foreign nations stockpiling commodities and moving away from the dollar, the United States faces a choice: adapt or decline. The savvy American investor who anticipates this shift is not betting against America. They are betting on the enduring value of American resources and the resilience of the American individual. You are securing a position of strength. When the dust settles and the paper currencies of the world have been revalued against hard assets, those who hold the metal will be the ones with the capital to rebuild, to invest, and to drive the next era of genuine economic growth. Therefore, view this coming week not just as a trading opportunity, but as a strategic pivot point for your family's legacy. We are moving from an era of financial abstraction back to an era of tangible reality. The January effect is simply the catalyst. The real story is the restoration of sovereignty to the individual investor. By taking action, you're ensuring that your personal fiscal responsibility acts as a shield against the collective irresponsibility of the state. You're securing a future where your economic resilience is guaranteed, not by the whims of a central banker, but by the weight of the metal in your hand. This is the ultimate definition of American prosperity: independence, security, and the freedom to chart your own course regardless of the economic storms that may rage around you. I would love to hear your thoughts on this. Do you believe these economic shifts will strengthen or weaken the American middle class? Let us discuss in the comments below. But as we know, deep analysis is useless without precise execution. So let us shift gears from understanding the problem to implementing the solution. We have dissected the $50 billion wall of capital, exposed the physical dealer blackout, and analyzed the macro superstorm. Now the analysis stops and the execution begins. Tonight, the electronic markets open. Tomorrow morning, the opening bell of 2026 rings. You have the information. Now you need the how. We need to keep our eyes locked on 3 specific price targets in the first week of January. Our first objective is the $75 mark. This is the previous high and the breakout point. If the pension funds enter aggressively on Friday, we should clear $75 within the first 48 hours of trading. Breaking $75 on high volume confirms that the correction is over and the green light turns on. Our second target is $83, which is the wick high from the Monday squeeze. Technically, price loves to revisit the scene of the crime, and I believe we will challenge $83 before the end of January. If we clear $83, we are in blue sky territory. Finally, our quarterly target is the triple digits, $100. If the shortages are as real as the premiums suggest, and if the bond market volatility continues, there is no structural resistance between $83 and $100. It is a vacuum. The price could move from $80 to $100 faster than it moved from $20 to $30. However, I need to have a serious conversation with you about the exit. Buying is easy, selling is hard. Most investors ride a bull market all the way up and then ride it all the way down because they fall in love with the asset. You are not a cultist, you are an investor. The goal is to increase your purchasing power. So when do you sell? You do not sell for dollars. Dollars are the problem. You sell for gold or land or income-producing assets. We use the gold to silver ratio as our GPS. Right now, the ratio is roughly 60 to 1, which is still cheap. Historically, in a bull market, the ratio compresses. When that ratio hits 40 to 1, you must pay attention, for the easy money has been made. When the ratio compresses further to 30 to 1, you should start to scale out by trading 20% of your silver for gold, effectively trading the high-risk asset for the no-risk asset to lock in the win. And when the ratio finally hits 15 to 1, you exit completely. Swap all your silver for gold or buy a farm or buy an apartment building. Move from speculation to generational wealth preservation. If you follow this plan, you do not care about the dollar price. We are about to enter a mania. A mania is different from a bull market. In a mania, people are irrational. You're going to see your friends and family, the ones who laughed at you, suddenly asking how to buy silver. This is the shoe shine boy indicator. When this happens, you will be tempted to use leverage to borrow money against your house to buy more. Do not do it. When the mania hits, your job is to be the adult in the room. Keep your head. Stick to the plan. Do not get greedy at the top. You bought at the bottom. You have already won. Your job now is just to land the plane safely. So, as we approach the market open tomorrow, keep this simple checklist in your mind. First, watch the Globex open tonight. If it gaps up, the demand is immediate. Second, watch the volume on Friday morning. We want to see high volume from pension funds stepping in, for if price rises on massive volume, it is the real deal. And third, watch the dealers. If the sold-out signs stay up next week, the squeeze is going vertical. 2025 was the warm-up. 2026 is the main event. We have the perfect storm: industrial scarcity, monetary collapse, geopolitical conflict, and institutional FOMO. There is no force on earth strong enough to stop this trend. The banks tried and failed. The governments tried and failed. Now the market takes over. You have done the work. You have prepared. Now all you have to do is watch. This is the year you have been waiting for. This is the year silver reclaims its throne. Happy New Year. Keep stacking, and I will see you on the other side of the open. Thank you for your time today. If you found this analysis valuable, please like and subscribe to join our community of informed citizens.